In the UK, something big is happening to the rental market, and barely nobody is talking about it. Corporate landlords are quietly taking over, and while that might not sound like a big problem, it could fundamentally reshape who controls housing, how much rent we all pay, and what rights renters really end up having decades into the future. Today we're answering, why are corporate landlords rising? What's pushing small landlords out the market? And what does it all mean for renters, homeowners and investors alike? And if you're new here, I'm William Gale. I run two national property businesses, British Homebuyers, a UK-wide home buying company, and British Homesellers, a UK-wide estate agency. And over the last 13 plus years, I've personally overseen over 14,000 property transactions worth more than £4.2 billion. So this channel is all about cutting through the noise and giving you the real story behind what's happening in the UK property market. Let's dive in. Chapter 1, the quiet exit of small landlords. For decades, the UK's rental market has been dominated by loads of small landlords. So on average, UK landlords hold 8.6 properties each, worth around 1.65 million. So look, that's not pocket change, obviously, but when you compare it to the scale of corporate landlords, they're relatively small players, because 1.65 million, half of that's probably debt. So Lloyds Bank, for instance, now owns over 5,000 homes. Granger UK, whose largest shareholder is BlackRock, owns over 11,000 rental properties. Between those two organisations alone, that's the equivalent of 1,860 small landlords gone. And we're at a crossroads. Do we want a small number of mega corporations to dominate the rental market, or do we want a diverse ecosystem of UK-based independent landlords? Because what's happening right now is not a natural transition, it's being driven by government policy. Chapter 2, why are smaller landlords being pushed out? Now, this is where my experience comes in over the last 13 years, where I've watched policy after policy quietly make life harder and harder for small landlords, and I've seen bigger and bigger landlords take over. One of the biggest things that's obviously pushed landlords out has been the extra 3% stamp duty surcharge introduced in 2016, which is now 5%, which, to be clear, I actually agree with this extra stamp duty. Homeowners should have priority over investors. But here's the kicker with all this. If you're buying 6 or more properties at once, you can sidestep the surcharge entirely. Corporate landlords don't pay these stamp duty rates plus that extra 5% stamp duty you or I would pay when buying an investment property. They instead pay these far lower rates without that extra 5% stamp duty as well. And in reality, who do you think are mostly buying more than 6 properties at a time? Well, it's obviously big corporate landlords. For instance, Lloyds Bank bought these 84 homes to add to their portfolio. So while individual landlords are paying £15,000 of stamp duty on a £250,000 buy-to-let property, a corporate like Lloyds buying 84 properties in bulk might pay £2,000 per property, saving over £1 million in tax. The rules are written to favour the big players and punish the smaller ones in this example. And look, I'm a property investor. I've benefited from the market. But this isn't about investment anymore. It's about monopoly. The exact thing the government sells they're trying to prevent in housing, letting investors push out buyers, is now happening on a much, much bigger scale, just with corporate landlords instead. Chapter 3, should we fear corporate landlords? Let's look at who's moving in. Granger PLC, which as I mentioned earlier is backed by BlackRock, own over 11,000 homes. Legal General have invested £3 billion into build to rent. Lloyds Living are now building and renting homes directly. They own over 5,000 homes. So these companies don't just own rental homes, they manage them like a portfolio of assets. And crucially, they're not affected by Section 24 because they're companies. They have legal teams for complex regulation, like managing the changes in the Renters' Rights Bill. They raise institutional funding at far cheaper rates. They build at scale. Meanwhile, your average landlord can't deduct mortgage interest and is being squeezed by rising interest rates and doesn't have the legal team on standby. It's a two-tier system and one side is quietly being pushed out. Chapter 4 is build to rent the problem. Now, build to rent sounds like a great idea on paper. A quick, easy way for the government to hit its building targets by incentivising a small number of corporates to quickly build 80% of the housing target. You end up getting modern developments, things like on-site gyms and co-working sites and concierge, and it's all beautifully professionally managed. And for some renters, this is amazing, it really is, but here's what you end up getting longer term. Power is centralised, fewer landlords are controlling more homes, and once a few companies own most of the market, well, we all know what happens next. Less competition, higher pricing power. We've seen it in food, telecoms, tech, and housing could be next. For example, Starbucks has 12.4% of the UK coffee shop market, just one company. They paid £7.2 million of corporation tax across 1,266 shop outlets. So on average, each Starbucks coffee shop you see on the high street pays £5,687 of corporation tax per year per shop. That clearly doesn't add up. And the way they achieve that is they shift their profits generated in the UK to lower tax countries where they can get away with lower levels of tax, which hurts the UK economy at the end of the day. If you encourage most of the housing rental market to be controlled by big corporations, you'll end up with the same scenario, wealth sucked out of the small middle class landlords and coffee shop owners into the big corporate companies and out the country. Chapter 5, are we creating a rent monopoly? As someone who's helped literally thousands of people move home, buyers, sellers, landlords, and tenants, here's what I see now. We are in the early stages of a rental monopoly. And if we're not careful, we'll create a system where your only rental option is from a faceless corporation, not a local landlord. Rent prices are dictated, not negotiated. Tenant experiences are processed through portals, not people. Because once small landlords are gone, they're not coming back. And if you've ever tried to contact your broadband provider, imagine that same service level, but for the home you're renting. Chapter 6. What needs to change? If we want a fairer, more balanced market, here's what I believe needs to happen. You need to level the tax rules, stop giving bulk buyers an unfair advantage. You need to incentivise a build to sell. Build to rent giants should see tax incentives to build to sell instead, not rent. And tax incentives should be around construction of property for selling. This will change stock being built to suit home ownership, not the easy rental management of properties. Because right now, we're incentivising the wrong thing, ownership consolidation. But what we want is ownership distribution, and we're all going to pay for it long term, tenants most of all. So who should own the future of renting? So why are corporate landlords taking over? Because the system has been redesigned to favour them. As someone who's been deep in this market for over a decade, I'm telling you now, if we don't course correct this, corporate control of housing will become the norm, not the exception. And once it's here, it won't leave quietly. So the question isn't, are corporate landlords taking over? It's what we're going to do about it. I'll see you in the next video up here.